Welcome to this explainer. Listen, if you're a beginner trader feeling incredibly frustrated right now because you just keep getting stopped out, or, if you feel like the market is literally hunting your positions, pull up at share. I'm going to step into the role of your mentor today. We're going to look at a modern, totally rule-based approach called the break and retest continuation strategy, or BRC for short. This is all about joining the trend with the real move, but only after confirmation. By the end of this explainer, you're going to see your charts entirely differently, and you'll have a strict mechanical blueprint for consistent profitability.
Okay, let's dive right into this. Have you ever watched a candle just blast through a key level, panicked that you were going to miss out on a massive move, bought in right at the absolute top, and then watched in total horror as the market instantly reversed and smashed your stop loss? Look, you are not alone. That sudden, violent reversal is exactly why beginners hemorrhage money on breakouts. You see a move, and you react emotionally rather than structurally. We need to dissect this trap right now so you never fall for it again.
I want you to burn this quote into your memory. Amateurs chase the breakout. Professionals wait for the retest. This is your new professional motto. Seriously, think of patience as your ultimate defensive weapon. When a breakout happens, amateurs let FOMO, that fear of missing out, take the wheel. But as a professional in training, you're going to use your patience to let the market show its true hand. Because after the trap and the reversal, the market actually trends. Our job? To join that trend on the pullback.
Here's our masterclass blueprint for today. 1. The beginner's trading trap. 2. Anatomy of the impulse. 3. Break, flip, and retest. 4. A step-by-step buy trade. And finally, 5. Risk, reward, and rules.
All right, let's kick things off with Section 1, the beginner's trading trap.
Now, what's really interesting about this is why it happens. There are 3 specific reasons chasing breakouts leads to losing trades for beginners. Number 1, falling for the trap and reversal. The market literally creates fake breakouts just to generate liquidity. Number 2, guessing without structural confirmation. If you buy just because a candle is green, you aren't trading, you're guessing. And number 3, trading against institutional timing. If you're trying to trade massive breakouts in the dead of the night when there's zero real volume, you are just going to get chopped to pieces by market noise.
Moving right along to Section 2, anatomy of the impulse.
Okay, so this is your step 1. Identify the impulse move. We are talking about big, bold candles here. Tiny wicks, fast displacement. This isn't your slow, grinding sideways market. This is a sudden, powerful injection of volume. When you see clear, massive candles leaving a level really quickly, that's the footprint of institutional activity. Spotting these clear candles is exactly how you stop trading against the big players and start trading alongside them.
But listen, an impulse move only matters if it happens at the right time. Timing is everything. You should only be looking for this setup during the London Open or the New York Open. Why? Because that's when the institutions are actually awake and sitting at their desks moving billions of dollars. If you see what looks like an impulse at 11 p.m. your time on a quiet Tuesday, just ignore it. Focus your attention on high-volume pairs like your USD, GBP USD, and gold, XAU USD, strictly during these 2 major session opens.
Which brings us to Section 3, break, flip, and retest.
Step 2 of our strategy is marking the break of structure, or BOS. So the crucial point here is that a true break of structure is your ultimate confirmation that the trend is real and not just another trap. For a buy setup, price has to powerfully break and actually close above the previous swing high. For a sell setup, it's got to break below the previous swing low. The BOS proves that the buyers or sellers are actually in the driver's seat. Once we have that break of structure, we move to step 3, finding the flip zone. Imagine an old ceiling in a building, right? The market blasts straight through that ceiling. What happens next? That old ceiling transforms into a new floor. Old resistance becomes new demand. Well, for a buy trade anyway. Conversely, old support becomes new supply for a sell trade. When you see this happen, you just simply draw a rectangle over that specific level on your chart.
And here is where the magic actually happens. Step 4. The retest. After the impulse and the breakout, price naturally gets exhausted and pulls back down to our newly formed rectangle, the flip zone. Do not chase the initial move. Waiting for this pullback to happen is exactly how waiting prevents those common beginner losses we talked about. When you buy at the retest, you're getting in at a discount, at a true institutional level, and it's perfectly aligned with the newly confirmed trend.
Let's make this concrete in Section 4, Step-by-Step Buy Trade.
Let's see how this all builds into our complete 5-step BRC framework. Just as a really quick recap, 1. Identify the impulse. 2. Mark the break of structure. 3. Find and draw out your flip zone. 4. Patiently wait for the retest. And 5. Execute your entry rules.
So imagine you and I are sitting right next to each other, staring at the charts at the London Open. Here is exactly what we're going to do for a full buy execution. First, we spot a strong bullish impulse, huge green candles. Second, we watch it break the previous swing high, confirming our BOS. Third, we draw a rectangle over the old resistance level. Fourth, we recognize that resistance has now flipped over to demand. Fifth, we literally sit on our hands and wait patiently until price pulls back down into our rectangle. Sixth, the exact moment it taps our zone, we enter our buy order. Seventh, we place our stop loss safely below the zone. And eighth, we set our take profit at the next structural high. That is a completely mechanical, entirely stress-free trade.
Finally, we have Section 5, Risk, Reward, and Rules.
And this brilliantly illustrates where we place our trades. Your stop loss goes strictly below the flip zone for a buy, or above it for a sell. Why? Because you're hiding your stop behind an institutional level. If price breaks back down through that floor, the setup is totally invalid anyway, and you absolutely want to be taken out of the trade safely. Your take profit is targeted practically at the next swing high or low. We aren't hoping for a moonshot here. We are just taking high probability structural targets.
Now, why is a minimum 3-to-1 reward-to-risk ratio absolutely essential? Because, quite frankly, it's the mathematical secret sauce of professional trading. If your target is 3 times larger than your stop-loss risk, you only need to win about 25 to 30% of your trades just to break even. You could literally suffer multiple beginner losses in a row, and one single successful break and retest trade wipes out all those losses and puts you right back in profit.
To wrap things up, these are your absolute golden rules. If you break these firm boundaries, you revert immediately back to being a guessing amateur. You must have a clear impulse. You must have a break of structure. You must wait for the retest. Again, do no chase. You must secure a minimum 1-to-3 risk-to-reward ratio, and you must only trade the London or New York sessions. Notice what's missing from this list? No guessing. No cluttered charts full of a dozen lagging indicators. Just clean price action, structural confirmation, and extreme patience.
So here is my final question for you as your mentor today. The strategy is clear, the rules are rigidly set, and the math undeniably works in your favor. But the real variable here is you. Will you have the discipline to stop chasing the market, sit on your hands, and actually wait for the retest at tomorrow's open? I highly encourage you to review these charts, mark out your levels, and just let the market come to you. Thanks for joining me for this explainer, and I'll catch you next time.